X 100%. Engineer your financial freedom.
All right, today we're jumping into a really exciting investment strategy. It's all about finding the future superstars of the stock market before everyone else does. We're talking about growth investing, basically the art of hunting for the next big thing.
So let me start with a quick question for you. What do giants like Amazon, Tesla, and Netflix all have in common? Well, yeah, today they pretty much dominate their fields, but the real answer is they all started out as small, disruptive companies with just massive potential. They were the exact kind of companies that growth investors dream about finding early. These are the tiny acorns that grow into mighty oak trees, and today we're going to learn how to spot them. So how are we going to do that? Well, we've got a super clear roadmap. First, we'll nail down what growth investing really is. Then we'll look at the anatomy of a potential star company, what makes it tick. After that, we'll get you set up with an investor's toolkit of key numbers to look at. Then we'll actually go hunting for opportunities. And, this is crucial, we'll finish up by talking about how to navigate the very real risks that come with the territory.
Okay, let's dive right into that first step. What exactly is this strategy? To find a growth stock, you first have to really get the core philosophy. It's not about what a company is worth right now. It's all about what it could be worth down the road. It's a bet on the future.
So what is it really? At its heart, growth investing is a strategy that is laser-focused on just one thing, capital appreciation. And that's just a fancy way of saying you want the stock's price to go up a lot. You're buying into a company not for a steady little paycheck, but because you believe that company is about to grow its sales and its earnings way, way faster than your average company. They're usually in exciting, fast-moving industries, think tech or biotech, and they pour every single penny they make right back into the business to fuel that insane growth. Now, this brings up a really key difference. How does this stack up against its famous cousin, value investing? This slide lays it out perfectly. Think of it like this. A growth investor is looking for that tiny acorn that has the DNA to become a massive oak tree. They're betting everything on that future potential. A value investor, on the other hand, is looking for a fully grown oak tree that just happens to be on sale for some reason. The growth investor's goal is pure capital gains, watching that stock price soar. The value investor is looking for steady dividends and for the market to realize the tree is worth more. And this means, yeah, growth investing is a lot riskier. That acorn might never even sprout. And since all the profits get reinvested, you can pretty much forget about dividends.
Okay, so we totally get the what. Now for the how. Now that we've got the main idea down, how do we actually spot one of these potential superstars out in the wild? It really comes down to looking for a very specific mix of qualities, what I like to call the anatomy of a star. And this all starts with the story of the company. The stuff you can't just plug into a spreadsheet. First, do they have visionary leadership? A CEO or a founder with a super clear, compelling vision and a history of actually getting things done. Then you look for a strong competitive advantage, what the legendary Warren Buffett calls an economic moat. This could be a powerful brand or some unique tech that keeps the competition away. And this next one is huge. Is it playing in a massive and growing market? This is what we call the total addressable market, or TAM. Just think of it as the biggest possible slice of pie the company could ever get. A big TAM means a long, long runway for growth. You put that together with a business model that's shaking things up and customers who are just fanatical about the product, and you've got a serious recipe for success. But listen, a great story is completely useless without the numbers to back it all up. These quantitative traits, the hard data, are the proof that the vision is actually turning into reality. The most obvious sign? Fast and steady revenue growth. But you also want to see that growth on the top line trickle down to the bottom line. That means looking for strong earnings per share, or EPS growth. This shows you the company isn't just getting bigger, it's getting more profitable. Expanding profit margins are an amazing sign that the business can scale. And a high return on equity, or ROE, tells you that the people in charge are really, really good at using your money to make even more money. Okay, so we know what to look for in the story and in the numbers. But to really dig in and analyze all that data, you need the right tools. So let's open up the Investor's Toolkit and check out 3 absolutely critical metrics for sizing up growth stocks. First up is the famous PE ratio. This just tells you how much the market is willing to shell out for every dollar of a company's current profits. Now, for growth stocks, this number is almost always sky high.
And that makes perfect sense, right? Investors are paying a premium not for the earnings the company has today, but for the huge earnings they expect it to have in the future. A high PE is basically the financial version of hype and optimism.
But that brings up a really important question. How do you know if that crazy high PE is actually justified? That's where the PEG ratio comes in. It's a brilliant little tool that puts the PE into context by dividing it by the company's expected earnings growth rate. I love this analogy. Think of the PE ratio as a car's price tag. The PEG ratio is the price tag adjusted for its horsepower. It helps you see if you're actually paying a fair price for the performance you're hoping to get. A PEG ratio under 1.0 is often a hint that the stock might actually be reasonably priced for its growth. Okay, but what about those really young, super fast-growing companies that aren't even profitable yet? Their PE ratio is totally meaningless. This is where the price-to-sales, or PS ratio, becomes your absolute best friend. It compares the company's total stock market value to its total sales. For these early-stage companies, sales growth is literally everything. The PS ratio lets you put a value on the company based on that one crucial metric, even before it starts making a profit. It's essential in hot sectors like cloud software or biotech. All right, we get the philosophy, we know what a growth company looks like, and we have the tools to analyze it. Now we get to the really exciting part. Let's talk about the actual practical strategies for going out and hunting for these opportunities. You can start by looking at the really big picture. Find those long-term, secular trends. These are the massive shifts changing our world, things like AI, the move to renewable energy, or breakthroughs in healthcare. The companies leading those charges are often fantastic growth candidates. Second, you can use stock screening tools to filter the whole market for companies that fit your criteria. Revenue growth over 20%, high ROE. Third, you gotta do your homework. Read everything you can. And finally, a great little trick is to see what the smart money is up to. Look at what successful growth-focused funds are buying. It can be a fantastic starting point for your own research. So we've covered a lot of really exciting ground, but we absolutely have to end this on a critical note of caution. The incredible potential for high rewards in growth investing is tied directly to its significant risks. High reward always means high risk, and you have to understand what you're signing up for. It's so important to know exactly what these risks are. First, there's valuation. Those high PE ratios mean these stocks are priced for absolute perfection, so any little bit of bad news can send the price falling off a cliff. Then there's volatility. The stock prices can swing like crazy from day to day, so you need a really strong stomach. They're also super sensitive to the economy. When a recession hits, these are usually the first stocks people sell. And remember, no dividends means there's no income to soften the blow if the stock price is dropping. And finally, there are risks tied to the company itself. You're often betting on younger companies, and let's be honest, they just have a higher chance of failing than some old established giant. And that really brings us to the core mindset you have to have. This is not a get-rich-quick scheme. The source material we used for this explainer puts it perfectly. Growth investing requires diligent research, a tolerance for risk, and a long-term perspective. You have to do the work, you have to be able to handle the wild rides, and you have to be willing to hold on for years to let that growth story really play out. So that brings us to the end of our deep dive into growth investing. We've defined the philosophy, we've dissected what makes a star company, and we've laid out both the tools for the hunt and the very real dangers along the way. Which leaves us with one final question for you to think about. After seeing both sides of the coin, what matters more to your personal investment philosophy? Is it the price you pay today or the incredible potential it might hold for tomorrow?